video, you will understand how credit scores work, how they are calculated, and why they are important in your future. So let's get started on this video. So, the first topic, how credit scores work. In the credit score world, the term credit simply means your reputation as a borrower, and it has to do with your history of staying on top of loans and credit cards. Some of you may be scared by getting a credit card or going in debt simply because of other stories that people in your life have had. But debt is simply a tool used to manipulate money. It's not good or bad, but it can be used in great and terrible ways. Before lenders will sign off on loans with you or open a new credit card for you, they want to find out your personal credit report. The credit report tells them your borrowing history. Based upon their credit report, the lender determines how much to charge you for the loan and whether or not to approve you for the loan or not. So, whether it's taking a loan out to pay for college, a new car, or a new house, credit scores are super important. So before we get on to how they are calculated, you need to know that a score is like a diploma. It's just a number that averages your history. You can look up your credit report, which has all the information on your borrowing on it, just like a grade report. But lenders, like banks and businesses, don't want to spend 15 minutes analyzing how well you pay back your loans, especially when they might have 300 applicants that day. Instead, credit bureaus use an algorithm, which is occasionally updated to give you a number, a credit report, a credit score. And that number is used by the banks and businesses to assess your credit worthiness. So, let's go on to how credit scores are calculated. So what determines your credit score? Credit scores are determined by credit bureaus or credit report agencies. But to get your credit score, you have to start with the credit report. Credit bureaus are simply companies that gather your financial information onto a report called your credit report. In the U.S., there are three main credit bureaus: Equifax, Experian, and TransUnion. The Fair Credit Reporting Act, issued by the U.S. government, sets standard guidelines for all credit agencies to follow when reporting on your credit. Other businesses, like lenders and banks, can buy your credit report from the credit bureaus. These credit bureaus use computer programs to analyze the credit report and give you a score, just like I explained earlier. This software scans the report for qualities, patterns, and potential pitfalls in your borrowing history. The credit score is usually what most lenders look at. With so many loan applicants, they don't have the time to wade through pages and pages of each person's credit report, so they just come up with a number. Credit scores make it easier and faster to determine your loan eligibility for applicants. So what's on a credit report? If you really want to see what's on your free credit report card, go sign up at creditsesame.com. That's what I use, and they give you a free credit report card. And they also give you a free credit score update every week. If you don't monitor your credit report or score very often, someone could be stealing your identity without you knowing it. Credit reports gather information about specific credit history events, so to speak. They list things about the amounts that you've borrowed, your payment history, whether or not you have any outstanding loans, any loans that you've had in the past 7 years, current loans, any minimum monthly payments that you're making, and instances of foreclosure or bankruptcy. So, how can we reverse engineer this? What factors make up your credit score? Each credit bureau puts out a credit score, or a FICO score. FICO credit scores range from 300 to 850. Now, the score is made up of the following factors. 10% of it is the type of credit. So is that an auto loan, a home loan, a credit card, a student loan? This makes a difference, but not very much. On to the next 10%. So new credit is basically your credit-seeking activity. Statistically, if you are seeking lots and lots of new credit in a short amount of time, you are seen as risky, which makes your score go down and your interest payment go up. Credit bureaus check these by something called hard inquiries, which is a term anytime a lender checks your score. The next 15% of the credit score is calculated by the length of credit. So this would be your oldest account, your newest account, and the average age. The largest portion of your credit score is determined by your payment history. Now this can be good or bad, but it also deletes off after 7 years. And if you have a bad payment history with a couple of bad notes, you can actually call some of the lenders and get some of these bad payment histories removed. The last 30% is the amount owed. So this is called credit utilization, which is the percentage of how much you've actually borrowed divided by how much you can borrow total. On a credit card where you might have a limit of $1,000, if you only use $200 of it, your credit utilization will be 20%. Experts say to keep it under 30% to stay in the clear, and under 10% for best results. So what do credit scores mean? Here's where the good credit versus bad credit comes in. A high credit score is a sign of a good borrowing history. The lower your score, the harder it is for lenders to approve your loans. They will see you as risky, and they won't want to give you money. It's common for lenders to set rules their applicants must fit in order to sign a loan with them.
Hope you like my video. Have a good evening all. And just let me know what you think. And hope this will work for you. Good night.